Hello everybody, this is Heinrich from Lightbulb Wealth Management, and I'd like to thank you for joining us on today's webinar. So the all-important disclaimer: all strategies and information provided in this presentation is general advice only and does not take into consideration your personal financial objectives or circumstances, and we highly recommend that you arrange an appointment to seek professional financial advice from either us or from another financial advisor and your accountant in regards to any taxation advice prior to acting on this information. So a little bit about Lightbulb Wealth Management. We provide personalised advice and holistic financial solutions to clients who are looking for a principal advisor. And I guess a principal advisor is that one point of contact that a client can have to provide them with comprehensive advice on any matter that is going to be important to that client. So for example, you might be specifically needing some advice on how to invest. We can provide that solution. As your personal financial circumstances change and as you progress through life, you might need retirement planning advice, superannuation advice. You might be thinking about how to transfer assets to your children or to other specific beneficiaries. So you might need some very specific estate planning and trust advice. Right through to advice around buying your first home, obtaining a mortgage, setting up a business, having some business advice, business lending advice. And so there are very few practices in Australia where you can actually receive principal advice from one firm that has the expertise and the capability to do that. And that's something that we've built out here at Lightbulb. We have an accounting solution and also a legal solution for clients. So just depending on the nature of your individual circumstances and what advice you're looking for, we can either assist directly or we can bring in the experts. But our proposition to clients is that we can provide you with principal advice both now and well into the future, and have that one point of contact. A little bit about me: I'm going on 14 years in the banking, finance and wealth management industry. I'm a licensed financial advisor and a licensed credit advisor. I've got memberships with the Financial Planning Association of Australia and the Finance Brokers Association of Australia, and I've got direct qualifications in financial planning and postgraduate qualifications in business and in management. I'm the Managing Director at Lightbulb Wealth Management, and I oversee all of the lending and wealth management operations. Agenda for today: it's a short presentation. We're going to cover off what is an investment bond, the advantages over superannuation, a case study, the strategic benefits, and next steps. So what is an investment bond? Well, effectively an investment bond is a unique structure. It's an internally taxed structure with a flat tax rate of 30%. After 10 years of investment, you're able to withdraw your investment money from the investment bond structure effectively tax-free. So as long as you hold the investment for 10 years up until the anniversary date, it's free from any personal tax, and that's because the tax is paid along the way. So the way that I like to think about an investment bond is to think of it simply as a tax structure similar to superannuation, in that superannuation is really simply a tax structure. And I use that as a comparison because most people understand superannuation as a tax vehicle, as a tax structure. The important thing to remember is that unlike superannuation, you don't need to meet a condition of release to access your funds. So within superannuation, you can't get to your money unless you actually meet a condition of release. So for most people, it's reaching a predefined age, usually somewhere around age 60 or 65, depending on your date of birth. So within an investment bond structure, your funds are always available to you throughout the investment journey. So you might start investing in the investment bond today, and maybe there's an emergency and you need those funds, within the first 12 months or 2 or 3 years from now. The funds are always available. You can withdraw them at any time. There is just some rules around the taxation a bit, and so to receive the full tax benefits of an investment bond, they really need to be held more for the long term. And of course, an investment bond is used for more than just effective tax planning and tax management. It's a great vehicle for accumulating wealth. We're going to talk about a case study around retirement, so it can be used for wanting to achieve an early retirement and also for estate planning purposes. So what are the advantages of an investment bond over superannuation? Well, like super, tax is paid along the way. Tax is paid at a slightly higher tax rate on an investment bond at 30% as opposed to 15% within superannuation, and the investments do not form part of your personal assessable income. Franked dividends reduce the amount of tax paid within the investment bond, and there's no need to include the details of the investment bond in your tax returns, no need to declare it to your accountant, unless of course you're making withdrawals within the 10-year tax period. Estate planning is one of the primary benefits also of having an investment bond, and so importantly, investors can nominate beneficiaries. Specific beneficiaries can benefit from the underlying investments if the investor passes, and importantly, the assets held within the investment bond structure do not form part of your estate assets. So unlike super, the money though is accessible at any time that you need it. No need to meet a condition of release. This is a major benefit of the investment bond structure. And there's no age limits, work tests or caps on contributions. Okay, so let's look at our first case study. Here we have clients Bill and Sue. They're both 45 years of age and they have a clear goal. They want to retire at age 55. Their current preservation age to be able to access their super is age 60. They're currently maximising their super contributions through their employer contributions. They don't want to put any more money into superannuation anyway. They need a strategy that's going to allow them the ability to withdraw funds on a monthly basis to fund their retirement. They would prefer not to access their superannuation until absolutely necessary, and so if they could have a strategy that would allow them to not access their super well after they're 60, that would be preferable. They've got investment funds of $50,000 to initially invest, and based on their cash flows, they've got around $5,000 per month to invest. So given that, what could Bill and Sue expect to achieve through investing via the investment bond structure? So here is a snapshot of the results. Bill and Sue sat down with their financial advisor to work out an investment strategy. The investment strategy delivered a net return after fees and charges and all taxes of 5%. The total contributions that Bill and Sue put into their investment bond was $650,000. The growth of the underlying investments was just over $204,000, and so the end value of the bond, the money that they receive in their hands at the end of the 10 years, is the $854,756 figure. No more taxes to pay, no capital gains tax, no income tax. A pretty good result. So what have been the investment bond benefits for Bill and Sue? Well, they've been able to reach their goals and they're now ready to retire at age 55. They always had 100% access to the funds. They have the ability to withdraw the funds now on a monthly basis, giving them a regular tax-effective income stream. We've worked out that based on the end balance that they could quite easily withdraw $80,000 per annum for the next 10 years to allow them to live the type of lifestyle that they want to live. One of their primary goals was to also be able to try to defer accessing their super for as long as possible. With this strategy, they're able to do that. So they've effectively pushed out having to access their superannuation by 5 years. So initially they would have been looking to access their super at age 60. Because of the investment bond structure, the underlying investments and how it's performed, they've been able to push out accessing their super until they're 65 years of age. And after 10 years of investing, there is no personal tax liability on the earnings and growth on the investment. Now let's look at case study number 2. A client by the name of Henry is a 52-year-old, well-paid project manager, has a high disposable income. He's looking for a way to build wealth, and super is really not an option for him and for his personal circumstances. He's currently maximising his salary sacrifice contributions into super. With the changes that came into effect on the 1st of July 2017, Henry wants to set up an alternative tax-effective investment vehicle, and he really doesn't want to access his superannuation until absolutely necessary. He's got $10,000 to invest, and he plans on contributing $1,000 per month, and he will increase this over time in line with the 125% rule. So here is a snapshot of the results achieved for Henry. So over the 10-year period, his contributions have been just over $409,000. The investment earnings within the investment bond have been 7%. That's net of all fees and charges and taxes. He's had $117,000 of capital growth, and in his hands, tax-free at the end of 10 years, he receives $526,261. So what have been the investment bond benefits for Henry? Well, there've been a number. It's been really easy for him to manage. It's flexible, no fuss. It's a great alternative investment structure. It's allowed him to have a regular savings plan in place where he can make regular contributions, and it's worked out very well for him. He's always had 100% access to his funds, and because he is a high income earner, the taxation part was important for him in regards to considering the investment bond structure. And so after 10 years of investing, there was no personal tax liability on the earnings and the growth on the investment. Henry doesn't have to include the investment growth or earnings from his bond in his personal tax return, so there's no further conversations that needs to be had with his accountant. No capital gains taxes. It's been very simple, very convenient for him from a tax perspective. So there are really 3 strategic reasons why you would have an investment bond, and they're suitable for all sorts of different life stages. So if you're looking to accumulate wealth, you need a vehicle where you can save in a structured way. Perhaps you're looking to save up for children's education. Maybe it's a big overseas holiday. Maybe you're thinking about buying, that dream boat, luxury car, or maybe it's saving for a home deposit to buy your first home. The investment bond structure is really great for being able to do that. From an estate planning perspective, many clients that we advise around estate planning, one of the primary goals is usually not to actually have an estate. It's more about being able to control where your wealth goes. And so having an investment bond allows you to nominate very specific beneficiaries, and ultimately the money that's accumulated within the investment bond structure does not form part of your estate assets, and that can be very important for estate planning purposes. And as the example that we covered off a bit earlier in the first case study, investment bonds are great for people that are transitioning to retirement, and they can be used in a real strategic way there, as I outlined in the example. So in terms of getting an investment bond and whether it's right for you, that will really depend on your own personal circumstances and your objectives and what you're trying to do. But one of the things to just think about, particularly if it's for tax efficient investing, if you're thinking about investing purely as a tax arbitrage type strategy, then ideally it's suited for people that are on taxable incomes in excess of 120,000, given the tax rates for FY financial year 21. Once you start earning over $120,000 up to $180,000, your marginal tax rate's 37%, so you're paying 37 cents on every dollar earned between 120,000 and 180. And obviously the earnings and the tax paid within the investment bond is 30%, so it is a more attractive tax rate, and it gets even more attractive if you're in the top marginal tax rate of 45%. So if you're earning over $180,000 a year, your top marginal tax rate is 45% plus Medicare levy, and so there's a significant tax saving within the investment bond structure. So if you're thinking about investing in your own name, you'll be taxed at 45% as a tax rate versus the investment bond at 30%. So it's a very attractive investment vehicle from a tax perspective. However, it's certainly not the only reason why you would do it, and you certainly don't need to be a high income earner to be taking advantage of the investment bond. So if you'd like to learn more about the investment bond structure, and then importantly what investments you should actually have and hold within the investment bond structure, then please feel free to reach out to us to have a discussion about your personal circumstances, and we'd be more than happy to help. You can reach us at contact@lightbulbwealth.com.au, or you can simply give us a call on the number displayed there on the slide, or visit our website at lightbulbwealth.com.au. So thank you very much for attending this short webinar. We hope you enjoyed it, and we'll see you soon. Thanks.